Financial Matters. My name's Dominic, and today we've got Randy, a financial planner advisor, that's agreed to come on the show. Good afternoon, Randy. Thanks for coming on the show. So tell us about yourself.
Well, I've been in the financial business for over 30 years now, and the reason why I came on this show is because you're kind of beaten up on annuities on some of your past videos, and I provide annuities to a lot of my clients, and they're making money and they're very happy.
Okay, and thank you for coming on the show. It should be an interesting interview. What don't I like about me? What do you like about annuities?
What I like about the annuities is that it gives you, it guarantees you that you're not going to outlive your income, and it provides a positive income during your lifetime.
Okay, so the fact that you can't outlive your income, which I think is like the number one concern of retirees, that's number one. And then the other thing you like about annuities is that you're going to get a nice return, and it's going to guarantee. So it's the perfect product, is what you're saying.
It's the perfect product. Now, there's a lot of different attitudes with clients. Some are at a high risk level, some are at a low risk level, and finding the right vehicle for them is also important, as you know, in our industry, so that they're comfortable with their money invested. And annuities, for some people, provides that.
I agree with you. That's safety. And there's different types of annuities. The variable annuity, which is in the market, then there's the index annuity, and there's a fixed annuity. I guess you do all types of annuities?
Yes.
Okay. So I guess what I'm trying to say is when I look at an annuity, I always feel like the returns are a lot less than they promise, than the agent promises. Like on the variable annuity, you put your money in the stock market and let's say you get 7% return, whatever's greater at the end of 10 years.
Right.
Okay. So let's say you put in $100,000 today, and let's say it says that you either get this mix of mutual funds that you're in, or we'll pay you 7.2% a year, because money doubles every 10 years at 7.2, as you know, rule 72. So in 10 years you're worth 200 at 7.2. Let's assume you got two buckets now. Tell me if I'm wrong. You got the investment bucket, and your investment bucket is your stocks and bonds. In 10 years, your 100,000 is worth 170, that 7.2 is worth 200. So I've got a choice. I either can take my investment bucket or I can take my accumulation bucket. Is that right?
True.
Now,
that's correct.
What you're going to tell your client is one bucket's worth 170, the other bucket's worth 2. What are you going to tell your client?
They can take out the 170 and spend it. On the 200,000, they'll get a return on that every year of $10,000. Not outliving your lifetime.
Okay, thank you, because now we're getting to the issue. The issue is that you're promising me, hey, you got 200,000, but that's not your money. The 170 is your mutual fund money. The 200 is not really your money. It's still our money, but we'll pay it out to you. And 10,000 on 200 grand is 5% a year. So you're going to give me 5% a year on my money for the rest of my life, correct?
Correct.
Okay, here's my problem. Let's do the math. Start with 100,000. 10 years later, I got 200,000. Right?
Right.
You give me 10%, or 10,000 a year. So that means in 10 years later, I get 100 grand back. So that means in 20 years, you've given me my own money back. Now, in 30 years, you've given me another 100 grand. So in 30 years, I got my 200. But here's my problem. If I take $100,000 and I amortize it over 30 years, my rate of return is less than 2.5% a year.
But the 200,000 is not your money. 100,000 of that is your money, and the rest is what you have made. So you're getting paid back on that.
Okay, let's change it around. Let's change it around just a little bit. I come to you. I'm an insurance agent. You're a retired person. You're retired, and I say, Randy, I got an investment for you. It's going to pay you 2.5% over the next 30 years. Would you buy it from me?
If I was very skeptical, if I was very paranoid about the stock market and was hesitant to invest on anything, then yes, I would.
But you're not even getting a market return. You'd be better off putting all your money in a money market. Money markets are paying 5% now. Now, granted, interest rates are up, I don't see how you could put somebody in an investment that's paying you way below market returns. And there's better investments out there. And not only that, what drives annuity sales is the comp. The comp you're making is obscene.
Dom, I think you're leaning too far into the annuity side of it. We provide a product that is trifold. 1/3 of that goes to annuities.
Okay.
Another third will go to a 60-40 stock split. And the last third will go to a whole life / term life care.
Okay. So so what you're saying is, as a financial planner, what you do is you do the 1/3, 1/3, 1/3.
Right.
Okay. So 60-40, 1/3, and then whole life. What do you like about whole life?
The whole life provides a tax deferred. You can borrow on your money.
What kind of growth are you getting on that whole life when it's in the plan?
You're getting 5% on that.
Okay, so it's growing at 5% a year.
Yes.
So your whole life is growing at 5% a year, and then you're telling me when the cash value grows, I could borrow against it.
That's right.
And why would I borrow against it?
Because you're not paying any taxes when you borrow against it.
Yeah, but I gotta pay interest on my own money.
But if you use it for long-term care, that is tax-free.
Okay, so what you're telling me is you're gonna put money in this hybrid plan, and the hybrid plan, you're gonna tie a whole life policy, which to me has no value. So you're gonna take a lousy engine and stick it on some good tires. Because why am I doing that? Why don't I just buy a long-term care policy? And why would I buy a lousy whole life plan, which, by the way, I challenge at 5 to 7% a year growth, because the cost of insurance, the cost to pay that agent a ridiculous amount of comp, like 110% of premium. What drives insurance products, Randy, and listen, you've been doing this a long time, I don't want to insult you, but you make a very good living selling insurance products, true or false?
Look, a lot of these insurance products have done well for my clients. Why should I not do that for them? And I should be able to make a decent living recommending good products.
But I challenge that they're good products, and you make a very good living. That's my argument. My argument is I don't think they're good products. In fact, I know they're not good products. Because when I do the numbers, it's just not coming out to be great products. You're basically putting me in a product that gives me a below average return, telling me I can get tax-free income in a whole life, but then I have to borrow against it. And then the other problem is when I die, I get face value, I lose all the cash value. So what happened to the $1 million of cash value? I got $2 million of face, I get no cash value. Here's what's interesting. The Society of Actuaries did a study. They said that high net worth people that buy whole life policies surrender within the first 6 years, and 77% of them don't hold it to death because they realize that they've been scammed.
You know, I take offense to that. Now you're probably going to tell me you don't like 60-40.
Okay, so 1/3 of your money has gone into a 60-40 stock bond mix.
Correct.
And you've done very well with that. Okay, let me ask you a question, Randy. You've been doing this a long time, 30 plus years, so you're not that old. But do you remember what interest rates were in 1980? Because in 1980,
It's around 20%.
they were very good. They were 20%. Interest rates from 1980 till a year ago continued to go down. And you know, when interest rates go down, bonds go up.
Right.
So the 60-40 over the last 40 plus years has looked fantastic because market's volatile, up and down, up and down.
Right.
Bonds, sort of that parachute. They rise through this volatile time period. They dampen that volatility. What if we're in now a 40-year rising interest rate environment? Is the 60-40 going to outperform if interest rates are rising? What do you think, Randy? What are your thoughts on that?
Look, the 60-40 has been tried and true. It's been around for a long time. And sure, there's volatility with the interest rates. But in the long term, 60-40 has always been a good vehicle.
Okay, but would you agree with me in 2022, 60-40 lost more than being 100% S&P. The TLT, the 20-year Treasury, was down 33%. The S&P was down 20. So if you were in a 60-40, which is a conservative mix, you lost more. And in fact, this year, the long bond is still down, and everybody's telling me I should buy bonds. So you think bonds are a good investment right now, true or false? Now
There's always good bonds out there. There may be fewer pickings, but there's always going to be some good bonds out there with some good interest rates on a short term. Dom, do you believe in diversification?
Well, Warren Buffett doesn't. Warren Buffett, honestly, Warren Buffett said diversification is a strategy for people that don't know what they're doing.
So if you don't like 60/40, you don't like annuities, you don't like diversification, what are you doing with your money?
Well, listen, I look at the environment, just like if it's snowing out, I'm thinking, okay, I gotta wear a ski jacket. Right now, interest rates are at a 22, 25-year high, right? The 1-year T-bill is close to 5.5%, 5.5%. So if I put my money in a 1-year T-bill, they can make 5.5%, no risk, anything.
But if the market goes up 20%, then you're not getting the gain on that. A 60/40 takes care of that.
Well, not if you do what I do.
What do you do?
Okay, we talked about the index annuity and what they do. There's annuities called the index annuities. Are you familiar with those?
Yes.
Most popular annuity sold, I'm sure you've sold those index annuities. They sell them as getting market returns without market risk.
Right.
Is that correct?
That's correct. You
And-
can be up 5%. When the market goes up, if it goes down, you don't lose anything.
Okay, great. What if I could give you the same thing as an index annuity, only not cap you, not give you a participation rate? I can give you almost 100% of the market with absolutely no downside risk. That would be a lot better than being an annuity that locks you in for 10, 20, or 30 years. That's what I do with my money. I take a 1-year T-bill. I invest my money in a 1-year T-bill, or I invest 95% of my client's money. Actually 94.5%. I take the 5.5% and I buy leveraged market instruments. That 5% can give me 70, 80% of the upside. And if the market goes down, my T-bill, which I put 950,000 in, is going to be worth $1 million. It's going to go back to $1 million. So I have no risk. I'm not locking my clients up. I'm not being paid 10% comp, excuse. I'm not looking to beat you up here. I'm making just my management fee and I'm building them inside my client's account. That is a much better way to invest. And no, yes, if my client wants exposure to gold, I can buy him GLD and I can do the same thing. But most of it in a T-bill, buy a derivative of GLD that will give him the market upside. Or if he wants to buy China, or if he wants to buy the NASDAQ, I can diversify him if you think there's better assets, but I don't have to buy an annuity or whole life policy and say, I don't want to own a long-term bond today.
Dom, I've been in this business for 30 years. I've got a lot of happy clients. I've put them into a lot of good vehicles. They're making money. You can't tell me that's not a good thing.
Randy, I'm not here to beat you up, and thank you for being on the show. Because again, I'm just doing the math, and it's hard for me to understand. And I just look at the math, and I don't see an annuity out there that I would put my clients into right now. And I'm not saying they've always been bad. I mean, I did like annuities back in the 90s when they weren't so greedy, but I just think insurance companies are greedy. I hope you can come back and debate this again. I appreciate your time, and I don't want to be negative on them. I understand some of your points. I understand why most advisors do it. I understand why most advisors have seminars, and what they're recommending is that 1/3 strategy. But I also think a lot of people are making a lot of money, and I'm not sure the best thing out there. So anyway, with that, thank you for coming on the show. Thank you for another edition of Financial Matters. We will see you next time on Things That Matter to You Financially.